Welcome to this month's update provided by Nikko Asset Management. It's the format that most of you will be familiar with. We'll spend the first half an hour until about 10:30 with a guest speaker from overseas, who I'll introduce in a moment. And then we'll be hearing briefly for two 15-minute slots from each of our domestic equities and bond teams here in New Zealand. But for those of you, Sam Korus from ARK Investment hasn't presented to us previously. So Sam, it's great to have you here. We're absolutely delighted that you can join us this morning. Your specialist areas, I understand, are around the robotics, autonomous vehicles, energy storage. So areas that are of a huge amount of interest to a number of people, and clearly the technology is evolving very, very rapidly. So people don't really want to hear from me. They're really interested in hearing what you've got to say. So I want to throw this open to you. We've got about 25-30 minutes or so, and look forward to everything you're going to share with us. So in your hands. Thanks, Sam.
Thank you very much, and excited to dive in. So I'll start off talking about electric vehicles, and then we can talk on automation and robotics a little bit after that. So I'll kind of kick it off, and I'll share my screen here. So just let me know if you are able to see this. All right. Can you see that all right?
Yeah, thanks, Sam. That's come through well.
Great. And so when we're talking about electric vehicles, I think it's in the news a lot now, much more than it was 4 years ago. But we're still at the very earliest days of the electric vehicle movement. So we think that there's still room for an acceleration in sales. And the key driver here is that we think electric vehicles are approaching sticker price parity with gas-powered cars. And so at that point, we think it really changes the type of demand that these vehicles will see. And this is being driven by Wright's law, which is that for every cumulative doubling of production, you get a fixed % cost decline. And that's the single largest cost component of the vehicle. And that's what's going to drive this price parity. And so, at the very high level, we think that EV sales are going to increase from roughly 2 million, where they were last year, to 40 million units sold globally in 2025. And really, this is going to create a huge amount of creative destruction as well. And one of the big question marks, even in our modeling here, is what happens to the traditional automakers? Can they successfully transition not just to electric, but also to autonomous vehicles? And so, I think this is a helpful chart just to look at the context of where we've been. It's been obviously a crazy last year, but even before that, electric vehicles have been continuously gaining share. You can see that in 2019, gas-powered cars were already down 4% for the year pre-pandemic, while electric vehicles were up 16%. And then even more so in 2020, with such disruption occurring, you had gas-powered vehicles down 15%, and actually this increased to 33% for electric vehicles. So electric vehicles, though a small part of the market, are already putting a dent in gas-powered vehicle sales. And we think that could accelerate, not just with the electric again, but also if autonomous comes along, that'd be an accelerant to the trend. And so here's a description and a classic looking Wright's law chart. And this is something that, at ARK is pretty fundamental to a lot of the work we do. And, as I said earlier, this is that for every cumulative doubling of production, and you can see that here on the x-axis, there's a fixed % cost decline, and that's measured on the y-axis here. And for battery cells, that amount is 28%. So that's pretty significant. And, as I mentioned earlier, is again, the largest cost component of the electric vehicle is the battery. And that's why it's so important. And often, when we say this, one of the key responses that we get or pushbacks is, is the electric vehicle actually that different from the gas-powered car? why aren't gas-powered cars, if they've been around for 100 years, why aren't they free? And the reason is that it is cumulative doubling of production, and so that's I'd say that's a fairly unintuitive concept to grasp. Whereas the line here doesn't intersect with the x-axis. Ultimately, as you cumulatively double, you'd need more energy and material than exists in the universe to get there. So it kind of ends at a certain point. And I think the key thing here is that a cumulative doubling takes longer the more mature your technology is. So if we look at gas-powered cars that have been around for 100 years, it would take roughly 80 years at current sales volume to reach a cumulative doubling. Whereas the lithium-ion battery and electric vehicles, there's been, I'd say, 5 to 10 million electric vehicles sold cumulatively throughout history. And so to cumulatively double 5 to 10 million that could happen in just a year or two. And so that's where you get this dramatic difference in the type of cost decline. And as you can see here, this has been extremely robust. And this is what is driving our cost decline model, which gets us to this next point here, which is sticker price parity. And this is one of the most important points that we like to make, is that in 2023, we think that a 350-mile range EV is going to be the exact same price or equivalent to a Toyota Camry. And at that point, you can imagine that a car shopper goes to a car dealership and the car dealer says to them, do you want the traditional Toyota Camry, or do you want the electric version? The electric version's a little bit cheaper, and you never need to take it to a gas station. You can charge it at your home. And it's also has lower maintenance bills. We think that's a fundamental shift in demand and easy decision for the end consumer. And then the point that I think a lot of people miss is, just because everyone's looking so much towards this sticker price parity as the tipping point, is what occurs after the tipping point. And so it's not as though all of a sudden the Wright's law, the cost decline for batteries, stops once it reaches price parity, right? It should continue to lower. And so you can see that in 2025, we think it's, you have to be crazy or really committed to this gas-powered Toyota Camry to be willing to pay $8,000 more for it. Alternatively, what you could see is that the electric vehicle might have $8,000 more content in it and still charge a similar price to the Toyota Camry. And one more point that I'll throw on here is that we do all of this modeling without subsidies. And so I know there's a recent subsidy in New Zealand announced, and subsidies are great and definitely help drive sales. But the reason that we do not include subsidies is because those are much harder to forecast than technology cost declines. And so, we stick to our expertise in focusing on the technology, as opposed to trying to read the political winds and whether subsidies will last or be pulled away. So we like to drive it just on the technological cost declines. And any type of subsidy is a tailwind to that. And so what we see today in the market is that really most EVs are competing on range and performance. And you can see here that there's a pretty clear trade-off between range and efficiency and performance, which we're measuring as 0 to 60 acceleration. And you can see, I think what's very interesting here is you can see the 2017 Chevy Bolt and the Chevy Bolt today. So 3 years and really not a lot of investment or improvement in it. You can see that's different with the Nissan Leaf, where the 2015 Nissan Leaf then improved and it's still slightly below this trend line, but clearly improvement over those 5 years. And then, I think equally interesting is that the outlier already was the 2018 Tesla Model 3, and Tesla's continued to accelerate and distance itself from the pack with the Model 3 all-wheel drive that it has today. And you can kind of see the difference here between what were called the quote Tesla killers, the e-tron, the I-Pace, the Mustang Mach-E, and the Porsche Taycan, all making huge sacrifices in efficiency in order to try and just compete on performance with the Model 3. And what we're talking about on this slide is what we call cell-to-vehicle technology. And this has been touted, this was touted by Tesla at Battery Day, as well as by BYD in China. And this is really the path forward for electric vehicles. And for a long time, car companies were talking about the skateboard technology. And what they were saying there is, we'll build the drivetrain, we'll put the batteries in a box, and then we'll just use that base and we'll put different structures on top, whether you want an SUV, a sedan, a pickup truck. And that was thought to be an efficient way forward. But actually what we're seeing is that was actually suboptimal. And we think we illustrate that in these photos over here. So what was happening in electric vehicles is you were taking the battery cell, and so that's energy in a box essentially, and you were putting that into a module. So you're putting a box inside of a box, and then you're taking those modules and you're putting them in a pack. So as a box in a box in a box, and then you're putting that pack into the vehicle. So it doesn't necessarily make sense to put 4 wrappers around energy. And so the new technology is just taking the cells and you're integrating them directly with the vehicle. And the reason that that's so important is that, as you can see in this chart, you're actually getting an increase of 50% on a volumetric density basis. And so what this means is that you can actually use a cheaper battery and pack more of them into the exact same space. So you have a cheaper electric vehicle that goes farther than otherwise would have been the case. And so this was, a change that not many people saw coming, but that is making a real difference in the segmentation of vehicles and the cost of an electric vehicle. And so all of this together is getting to this point that, if traditional automakers overcome obstacles and they invest heavily in electric vehicles, which we're seeing them do, we think that EV sales could go 20-fold. So that's an 82% CAGR over 5 years and reach 40 million by 2025. And then as an end note here on the electric vehicle section is that we think that neighborhood electric vehicles or these smaller form factor electric vehicles could be a pretty significant share of electric vehicles sold, particularly in developing markets. And we're already seeing that today. And there's a vehicle called the, I believe it's GM and SAIC, their joint venture, and it's called the Wuling Mini EV. And this is a car that costs, $4,000 to $6,000, and it's selling like hotcakes in China. So definitely not a, super fast car, but it gets you from point A to point B, and it's being mass produced and people are buying it.
Sam, a couple of questions that are coming through on this.
Yeah.
In particularly maybe around some of the headwinds to this ramp up. One is around just the materials, like the rare earth materials and the lithium that goes into the batteries necessary for the scale of production. And then secondly, whether we're going to end up with some homogeneous fittings so that all the different types of cars can all be plugged in a similar way rather than everyone having their own different types of charging nodules, which could make things more complicated. You buy one car, it won't fit into the charging station. Any thoughts on some of those obstacles?
Sure. So we'll start with the raw materials one. And so from a pure raw material basis, we've done the research there, and we do not see any shortage of raw materials. Where things get more complicated is just because those raw materials exist and are available on Earth, it doesn't mean that you can extract them and process them in a fast enough timeline. So oftentimes people will point and they say, mining is a fairly slow industry. Even to ramp up, it would take 5 years to expand to meet production. That is a possibility, though. From everything we're hearing, the price signals have kind of followed a similar commodity boom bust type environment. So you've had Elon Musk out there saying, if you're a nickel miner, we'll commit to buying your nickel. And the prices of those raw materials have increased. And we think that those price signals have incentivized miners to ramp up production. So, we do think that the materials will be there for these vehicles. I will say that, an interesting thing to think about here is, if there is a shortage, where do those batteries go? And oftentimes we get asked, why are you so bullish on electric vehicles, but you talk less about stationary energy storage? And so we do think stationary energy storage is going to be a large end market. But you can imagine that if there were a shortage, all of the cells would go into vehicles because they're a higher margin product. And so I think that's an interesting dynamic to keep in mind as well. And then as far as the standardization, I do think that more standardization will occur. I think there's news just today saying that Tesla is going to open its chargers to other vehicle makers in Norway. I think China likely, just given its environment, is probably more suited to standardization. And I think, even today, I don't think it's a huge issue given the dongles and different converters that you can use to connect to ones that aren't. But I do think that over the long term, it would not be surprising to see more standardization. Are there any other questions, or should I go on?
There's just one question, Sam, around the recycling of batteries. I guess that's coming from both an ESG perspective, just around good stewardship of those resources, but also how that factors into cost and life cycle of the vehicle.
Sure. So we think recycling is going to be extremely important, more so down the road, just because right now, if you just look at the sales cycle and the life of electric vehicles, the real significant amount of recycling will probably be in 10 years from now, once you're starting to get those vehicles off the road. So, I think that's very important. And I think the other piece of recycling that is less looked at, but equally important, is right on the manufacturing line for batteries. And that's because even in great battery factories, your yield isn't 100% for the batteries that you're producing. So if you can take those batteries that fail quality assurance at the end and just recycle those raw materials back into the beginning of the process, you can drive cost declines there. So I definitely think that we're going to see the recycling market continue to grow alongside the battery market, and it should contribute to cost declines as time goes on.
Excellent. Thanks, Sam. We've got about 10 minutes, so why don't we move on to the next part of your presentation?
Sounds good. So the next part I'll go through quickly and then dive into some new stuff that we just published. But the high line here is that automation, as soon as you say automation, most people freak out. They say, jobs are going to be destroyed. There's going to be massive unemployment. But all of the work that we're doing suggests that they're actually going to boost productivity, empower humans, potentially create significant wage growth for certain individuals. And the key point here is that it shifts unpaid labor into paid labor. And I'll get back to that point, but that's a real key point. And so we believe that automation is going to add 5% or roughly 1.2 trillion to US GDP during the next 5 years. And so just as context, on the left here, we have US manufacturing robot density. And on the right, we have the US economy automation density as a whole. And it took 25 years to hit the current level of automation in the manufacturing industry. So you can see that here. And we think that it'll just take 5 years for that to occur across the rest of the economy. And a huge part of this could be, but is not necessarily that, is autonomous vehicles could dramatically increase the level of automation in the market. And what we're seeing is that industrial robot demand has hit an inflection point. And so on the right here, you can see that unit price of an industrial robot, and that's coming down according to its own Wright's Law curve. And you can see that, following the Great Recession in 08-09, and perhaps in response to it, as companies were forced to change the way that they were behaving and look at new options, there was a huge uptick in the sale of industrial robots, and that trend has continued on. Obviously, 2019, there was US and China trade wins. In 2020, we don't have those official numbers, but I'm sure it was negatively impacted by coronavirus. But we think that we could actually see something similar to the 08-09 crisis, where all of a sudden you have companies that are forced to change the way they think about the world and invest in robotics, a way to do things cheaper, better, faster. And so we think that could continue to take off. And so I'll kind of jump ahead to what I think is the key point here. And so this is a new blog that we just put out. And it gets to the two key points that we think people miss with automation and the conversation around it. And it's that automation can increase wages and that automation can transform non-market activity into commercial activity. And so, people like to argue this time is different. The tractor, here is an example of the productivity it increased. It reduced the labor hours required to produce 100 pounds of lint cotton from 42 hours to 2.5 hours. And it decreased the amount of land from 0.4 acres to 0.2. So that's a 17-fold increase in labor productivity. Even the tools we have today don't seem to be offering that same level of productivity uplift. And if you look at the steepest part of the adoption curve for when the tractor is being adopted, you actually had purchasing power of farm workers increasing during that time. So it actually was a great time for farmers because they had this new tool. And then oftentimes people say it's going to destroy these jobs. And you can see here the paid versus unpaid farm workers. And this is getting to that second point there. So total employment dropped from 10 million to 4 million over the course of 25 years. And 82% of those 6 million jobs lost were actually unpaid family workers. So it wasn't a matter of jobs being destroyed. It was actually, taking this non-market activity and converting it into market activity. And so another example, more forward-looking, that I like to point to is in the US and autonomous vehicles and taxi / ride-hailing drivers. And so in the US, there's 1.1 million professional taxi / ride-hailing drivers. But the reality of it is that there's 225 million non-professional drivers. So no one's paying me or anyone else to get in their car and drive to work. And that's a huge amount of non-market activity that's just not captured anywhere. It's not going anywhere. But you can imagine that if a autonomous vehicle were to enter, and we've done the work suggesting that it would cost just 25 cents per mile. And so it's actually cheaper for me to pay that 25 cents per mile as a service rather than to spend the money driving my own vehicle, which costs 70 cents per mile. And so you'd get rid of the need for those 1.1 million professional drivers. But in the early days, you'd probably need a number of remote operators in order to actually oversee the system of autonomous taxi networks. And so our modeling suggests that because you're bringing this huge amount of non-market activity into the market, you'd probably need 3 million remote operators for the system. And so you'd be taking non-market activity, bringing it into the market, and actually creating a huge number of jobs along with it, even though if you just look very narrowly at the taxi cab drivers, you'd say, oh no, all of these jobs are being lost. But actually, if you just step back and look at the economy as a whole, you're actually creating a bigger opportunity and more jobs, and you're increasing the size of the market. And so all of this to be said, I know we're running out of time here. We don't think this time is different. We think the burden of proof lies with those saying that this time is different and it will cause technological unemployment. This is a huge opportunity, but it probably will require a lot of education and retraining. And so we do think that those initiatives and efforts are very important, and that retraining is going to be a key role as automation continues to seep throughout the economy. And I'll stop there with 2 minutes for questions. I don't know if any came in.
I think we could chat for a long time on a lot of this stuff, Sam. It's really exciting. One of the areas around autonomous vehicles that I know that Kathy's picked up on when she's spoken to us in the past is potentially around flying autonomous vehicles. So taking the infrastructure off the roads and potentially utilizing almost like a three-dimensional transport network. Thoughts on where that's at in terms of development and likelihood of any commercialization?
Sure. So we're seeing a number of companies go public via SPAC that are doing air taxis. And sorry for a second here. So they're going public via SPAC. From a technology side, we think they're getting very close and so should be able to take off. It's really a regulatory question. And we're seeing those dynamics change. And actually New Zealand and Australia, very far ahead of the pack as far as regulatory being forward thinking and allowing this. So we're seeing a lot of tests going on there, some tests in Europe occurring, and actually the US a little bit more behind when it comes to aviation.
Well, I am conscious that we've used up our half hour. We'd love to have you back another day because I'm sure there's lots more that we could explore and talk about. But for your time, for giving up your evening on a Thursday night for you, look, thank you very much indeed, Sam. Enjoy the rest of your evening, and we'll catch up again soon, I hope.
Sounds good, and happy to answer any questions asynchronously as well.
Appreciate that. Thanks. Now, take care. Bye bye. We're now going to turn our attentions to a couple more, maybe slightly domestic matters, but also thinking about that in the context of the global economy. We'll be considering what's happening to interest rates, inflation, and some of the data that's been coming out of some of the central banks. So to that, our resident expert and head of bonds and currency, Fergus McDonald. Over to you, Fergus.
Thanks, George. I thought that first of all, just start with month-to-date performance out of New Zealand bond markets. They're pretty a little bit ho-hum, but ho-hum on the slight positive side. So month-to-date out of most of the sectors of the bond market, slightly on the positive side, which is a good thing. I thought I'd just start the first part of my talk really looking at what's been happening with the Fed, basically the world central bank, if you want. They've basically brought forward their time period for their first rate rise. potentially as early as 2022, and previously they were talking about 23, even 24. And basically acknowledging that the labour market is strong, which is primarily the main determinant of the timing for rate rises, but also generally the economic environment is strong as well. However, I guess on the health front, rates of inoculation are obviously a cause for hope. However, the new COVID variant, the Delta variant, which first emerged in India, and now the Delta Plus variant as well, is basically seen a surge in Russia, parts of Europe, UK. That's the strain which is raging in Fiji and causing concern in Sydney and in the US. So I guess that we can't take everything for granted at the moment, but from the economic front, things are looking relatively kind of positive. That was kind of confirmed when we had New Zealand's GDP data for the March quarter jumped 1.6%, which is 2.4% year on year, which is quite a bit stronger than all pundits were picking. Prior to that, I think the most optimistic was about 0.8, so it's pretty much double the most optimistic, and certainly much stronger than the RBNZ was anticipating. So we're basically, like the Fed, I think the OCR rates of say 1% in 2022 is possible, perhaps before peaking around the 2% mark in 2023. The start date of that cycle is in all likelihood been brought forward to possibly early 2022. 2021 can't be ruled out. November is one of the later opportunities for the RBNZ. That may be a little bit too soon, but if everything goes according to plan and the economy continues to do well, 2022 rather than previously 2023 being the start of that tightening cycle. We continue to expect this tightening cycle to be modest, however, with the OCR peaking around 2%. And when it does, I think we'll have a flat yield curve, basically where the long-term interest rates of government bonds and the OCR at similar levels are around that kind of 2% mark. Current 10-year bond yields are hovering around about 1.8%. And if you remember, they bottomed at around about 0.4% September, October 2020. So long-term interest rates have already increased quite considerably from their lows, and perhaps now it's a term for short-term interest rates to follow. But remember, during other tightening cycles, since we've had the OCR, the best time to buy long bonds is before the start of the tightening cycle. And so if we are correct in that the tightening cycle is going to now start earlier, the time frame for buying longer bonds has also probably shortened up as well. We currently see value in long-term bonds should the 10-year government bond yield get to around about 2%. So that's, as I said, around about 1.8% at the moment, so not too far from where we are at the moment. And that would probably mean high-grade credits, such as LGFA, housing, other types of credit would be trading in the 2.5% to 3% range. Perhaps other credits maybe slightly wider. So, as I said previously, often in the past, the best time to buy long bonds is close to the first stage of the tightening cycle. We don't see why that should be any different this time round. And the rationale for buying at the start of a tightening cycle is really that we're moving from a stimulatory to a more restrictive monetary policy settings that should, over time, reduce economic growth and inflation. And these in turn are exactly the conditions that make owning long-term assets, long-term bonds attractive. And from a wider context, if we believe that longer-term bond yields are if not quite at their top just yet, relatively close to it. All other assets which use risk-free rates of 10-year bonds or indeed swap curves as the basis for the evaluation, probably don't have too much more to fear for, in my opinion, for rising long-term bond rates. So what are we kind of doing with our portfolios, if that's our kind of thought process going forward? We're currently continue to be a bit cautious about having too much duration in the portfolios at present. So even though we think that long-term bonds are starting to represent value, we think that there'll be opportunities still to come for them to be a little bit to buy at a little bit higher levels. So we're biding our time, waiting for that lift in longer-term rates. But that's we think will be represent an opportunity to lengthen. We also want to move to a barbell position in the portfolios, and what that really means is that we want to be overweight in shorter-term assets, and we want to be overweight in longer-term assets, but we probably want to be underweight the mid part of the yield curve. That's probably a transition over this next year or so, but that's we probably see the safer parts of the yield curve as in being the very short bonds and also probably the very long bonds, because the long bonds have already priced in quite a bit of the tightening cycle already. The very long-term bonds in New Zealand government bonds, 2041s, are currently around the 2.6 mark. There's going to be a long-term, even longer-term bond of 2050 coming our way, issued by the Treasury, and that bond could hover around the high 2s to 3%. We think that if the OCR does peak at 2, having still at that peak having a 1% or higher interest rate compensation for term probably represents a reasonable value. Just kind of turning to a little bit on the New Zealand dollar. Even though first quarter GDP was quite strong, as I said, and was higher than expected, the Kiwi dollar actually weakened around that time period. But that was probably mainly because other central banks, with the Fed being most prominent, also brought forward their timing of rate rises, or certainly the expectation of rate rises, and that's certainly how the market was anticipating it. So the whole globe seems to be performing quite strongly, not just New Zealand. And perhaps since New Zealand had a V-shaped recovery, economic recovery, sooner than the rest of the world, perhaps even though the economy is going quite well, the rest of the world may just outperform us over the balance of maybe 2021 and into 22. The other little bits and pieces, there hasn't been that much in the way of new issuance. There was a new government bond, 2032 bond, which was issued at a yield around 1.9%, close to it. There was an institutional issue of a 3-year floating rate note by Rabobank. But possibly more interesting, it was an issue which perhaps didn't come to the New Zealand market, and that was the ANZ issued $1 billion in offshore markets, and the pricing for that was comparable to cheaper than if they are issuing that type of volume in New Zealand. So I guess there are still opportunities for the banks and other credit high quality for borrowers to borrow and offshore and to tap those offshore markets. The most bond issues in New Zealand have tended to be well and truly oversubscribed, and this does still seem to be more money chasing assets than the other way around. Just a little comment on Westpac New Zealand. Obviously, there was an announcement that it's going to be retained within the Westpac group. I think that would have been quite nice, an asset which would be sought after by the equity market. But from a bond perspective and a lender to Westpac and the Westpac group in general, it's probably better to have a more diverse group of assets as our security. So as a debt holder, we're not particularly upset by that decision. And the market, the debt market probably appreciated that as well. Because of that uncertainty of longer term ownership for Westpac, we had seen over the last few months the yield margin over the other Aussie banks widened by about 10 basis points at its peak. Upon that announcement, the Westpac, the local Westpac debt contracted by about 5 basis points in margins, and maybe might be wider than the other Aussie banks by about 2 basis points. So nothing too much. We had actually been for our portfolios been a buyer of Westpac paper over the last little while, so that was a small benefit for the portfolios. Just a little bit of a slightly related matter. New Zealand Debt Management Office has increased its weekly government bond tenders size from 300 million to 500 million starting in July, and I guess that July is the start of the new financial year. The DMO may well be pre-funding some of its requirements, as it certainly did last year. And if economic performance and tax revenues continue to be strong, we'd perhaps expect this funding requirement to lessen as the year progresses. They do, which is probably quite the right thing to do. They are quite conservative in their borrowing program, and we think that will continue to be the same going forward. So we'd expect a level of overfunding. We do note that the government, which had set aside a $50 billion pot to support the economy through COVID, has been dipped into for other purposes as well, which isn't necessarily kind of directly COVID related. So maybe that's part of the kind of thinking as well, by perhaps increasing the size of those tenders. Just as I'm perhaps coming to the end, I just sure it's something which some of you have probably seen, but for those capitalists amongst you, you'd be very pleased to see that the 2021 Credit Suisse Global Wealth Report, New Zealanders have the 4th largest median wealth per adult in the world. Unfortunately, from a competitive perspective, that's behind Australia, who is number 1, Belgium and Hong Kong. So, and this is for, as I said, per adult. And just to put some numbers in that, that's a median of a little bit over $171,000 US dollars. A lot of that is actually because the Kiwi has been actually quite strong against the US dollar, and also because of our property market. So perhaps on that cheery note, I might just kind of hand back to you, George, and let's see whether there's actually any kind of questions that may have come on through.
Thanks, Ferg. Look, we've probably, you've timed that perfectly to 10:45, so congratulations on that. There's probably some areas around inflation and so on that we could have touched on, but maybe we'll save that powder for another day.
Yeah, thanks, George.
All right, thanks, Fergus. For the final session this morning, I'd like to introduce you to Owen Batchelor. As part of what would be really helpful through these sessions is actually just to introduce you all to wider members of the team as well as those familiar faces. Owen's been with Nikko Asset Management now for about 18 months. He'd previously been working on the sales side of the industry as a broker, where he's got particular expertise in a number of different areas. And his responsibilities at Nikko Asset Management include the gentailers, infrastructure, and the Australian REIT companies. So across all of that, he's probably responsible for somewhere in the order of about quarter of the market in terms of research responsibilities. So it's great to have Owen presenting. He's obviously familiar to the Nikko team, but less so to the audience here. So Owen, it's great to be able to have you speak to everyone on this call. And for the next 15 minutes or so, I believe you're going to take us through a number of particular areas of your expertise. So we're in your hands. Thanks.
Thanks, George. Yeah, so today I'm going to be talking about the New Zealand generation retailer sector, or gentailer, and also airports. So I've got some slides to share, which I will do so now. You see the slides? Perfect. So this first slide provides I suppose, a quick overview of the gentailer sector for those who aren't overly familiar with it. There's 5 stocks in the sector, and the top left-hand chart shows that 3 of them sit within the largest 15 companies in the New Zealand market. So, you know, they're reasonably large stocks, which is why the team here spend quite a bit of time talking about them. The top right-hand chart on the slide shows generation market share for each of the stocks. As you can see, Meridian is largest by quite some way at around 30 to 35% of total generation. Then you drop down to Contact, Genesis, and Mercury, before dropping down to Trustpower, which is about 5%. The bottom left-hand chart shows the percentage of electricity generated in the North Island and South Island for each stock in the sector. And the bottom right-hand chart shows the percentage of renewable generation. Most are either fully renewable or very close. And I suppose on a whole sector basis, New Zealand is around 86% renewable in an average year, which is pretty good, particularly in a global context. This next slide highlights the share prices for the sector over the past few years. The gentailer sector has traditionally been one that has been relatively stable and predictable. However, the past 18 months or so have been very different. We've talked before about the Tiwai Point aluminium smelter, which, as you can see, caused some pretty major moves and a huge amount of uncertainty for well over a year. But without a doubt, the largest impact on the sector was the BlackRock Clean Energy ETF buying, which started in mid-October. As you can see, this saw the share prices of Meridian and Contact almost double over 4 months, before pulling back in mid-February as the ETF announced a change in methodology, which saw Contact and Meridian significantly downweighted. So where are we at now? Well, TY has committed for another 4 years, and we don't have ETFs dominating share price performance anymore. However, in terms of underlying electricity market dynamics, the sector isn't really back to normal. And there's 2 issues going on in the sector at the moment. Firstly, low hydro lake levels, and secondly, reduced gas availability. So the top left-hand chart on this slide shows lake storage levels. The dark blue line represents the 90-year average lake level, while the red line is the lake levels for 2021 to date. As you can see, the red line is well below the blue line, and in fact, lake levels at present are only around 70% of historical averages. The top right chart shows the gas production at the largest gas field in the country, Pohokura, and you can see that production has been steadily declining since May last year. Now, both of these factors are combining to cause elevated wholesale prices, which you can see in the bottom left-hand chart. Spot prices are close to $300 per megawatt hour at present, which is much higher than historical levels, which sit somewhere between $70 to $90 per megawatt hour. The bottom right chart is quite interesting, and it shows another consequence of low lake levels and therefore reduced hydro generation, and that is elevated thermal generation to make up the difference. You can see this in the red area of the chart, which has increased recently. And to make things worse, given the shortage of gas, most of this generation is coal-fired, which is obviously not great from an environmental standpoint. I've just recently been on a trip with the Genesis Energy executive team, and they told me that currently 8,600 tonnes of coal is being burnt at Hunley every single day.
Owen, could actually just linked into that, which is quite interesting. That we had Sam Korus on the call earlier, talking about the growth in electric vehicles and what that means. Just looking at some of those, the cost of electricity rising, what does that mean for maybe charging up electric vehicles and the availability of energy for supplying this flood of electric vehicles that are predicted to enter into the market? Have you got any thoughts on that?
Yeah, look, that's certainly an interesting question. I mean, ultimately EVs are still, a few years away. The current dynamics are, and the current, high wholesale prices are expected to remain with us for a few years. But as renewable generation comes online, then prices are expected to normalize about the $70 to $80 mark. So I don't expect by the time EVs come through that we should be sitting with extremely high prices. So whatever modeling is being done on electricity prices somewhere between $70 to $90 per megawatt hour should probably be the base case, I suppose, for electricity costs going forward.
Okay, thanks.
If we move on to the next slide, which we're on now, this really sort of looks at the sector outlook. And I suppose the first thing to say on this slide is that wholesale electricity prices, as I said before, are expected to remain elevated near term. And you can see this in the electricity futures prices chart on the top left there. The next chart to focus on this slide is the bottom chart, which shows the electricity supply demand balance for the next 5 years or so. Now, there's lots of moving pieces in this chart, but essentially in the green box, you've got that renewable supply coming online, which I touched on before, George. And this is coming from all the major gentailers. In the orange box, you've got a large amount of supply should TY close. And then balancing that on the other side, in the blue box, you've got the retirement of thermal supply, along with some underlying demand growth. But one of the most important parts of the supply-demand balance is that last red box. So that's the amount of electricity demand required in the lower South Island to keep the market balanced if TY does leave in 2024. So, stimulating this demand is a really big focus for the likes of Contact and Meridian, being South Island generators. So where's this demand going to come from? Well, there's essentially three demand sources that the sector's thinking about at the moment. And those are firstly process heat. So, converting South Island dairy boilers from running on coal to running on electricity. Data centers, which both Contact and Meridian are making early progress on. And green hydrogen production, which is a large opportunity given the demand coming out of the likes of Japan and South Korea, but it's likely more a longer-term play.
Anything to say on wind power, Owen? I know that you were recently looking at a potential wind site.
Yeah, so I was recently down and looking at the Waipipi wind farm, which was Tilt's farm that Genesis has got a 20-year PPA off the back. Look, wind farm is certainly I suppose, the choice of renewable generation at the moment, and almost all major gentailers are exploring wind projects, along with starting to look at solar projects up north. Just moving on to this next slide, this sort of provides an overview of how we think about valuation in the sector. And I suppose the key takeaway from this slide is that the sector has a very strong relationship with interest rates. The top two charts show the correlation between Meridian Energy and Contact's Energy EBITDA multiple with New Zealand government bond yields. The relationship is again shown in that bottom left-hand chart, which shows the spread between New Zealand government bond yields and each of the stocks' gross dividend yield. As you can see, up until COVID hit, the stocks traded at relatively stable spreads to government bond yields. COVID, TY, and as I said, ETF impacts sort of caused the relationship, I suppose, to break down a bit. But as those impacts have disappeared of late, we're starting to see some more stability again in these yield spreads. If we move on to the final slide on gentailers, in terms of preferences and positioning, look, we're currently 70 basis points underweight the electricity names. Our only overweight in the sector at the moment is Contact, and that's really based on two aspects. Firstly, valuation support, and secondly, we see a potential for the stock to re-rate once it moves to a fully renewable generation base and it starts to look a bit more like Mercury and Meridian. Both Mercury and Meridian have high quality renewable portfolios and certainly strong management teams. Mercury has some of the strongest dividend growth near term, but we see the stock as a touch expensive at the moment, so we've currently got a moderate underweight. Meridian has been expensive over the past few months, so we've been sitting underweight, but it has recently moved into into fair value territory. So we're now sitting broadly neutral, that name. I might just move very quickly to my second topic, airports, which I can flick through pretty quickly. So look, when it comes to airports, there's two options for us. It's Auckland Airport and Sydney Airport. And non-COVID times, they're very attractive businesses. They both have strong track records of delivering consistent earnings and dividend growth over time. Both airports have very similar business models, which you can see in the top left-hand chart there that outlines the revenue split. They're both dual-till airports, which means only the aeronautical side of the business is regulated. And when it comes to regulation, they're both subject to what's called light-handed regulation. Being dual-till with light-handed regulation is very attractive attributes relative to global airports around the world. However, one difference to point out between the two comes to do with passenger mix. So the top right-hand chart on the slide shows the split between domestic and international passengers. Auckland Airport has a greater reliance, as you can see, on international passengers, whereas Sydney is a more domestically focused airport, with only 38% of its passengers coming from international, compared to Auckland's 55%. Now, this is really important when thinking about the recovery profile of both airports. And if we think specifically about international passengers, another difference is shown in the pie charts below. So 31% of Auckland's international passengers are from Australia, whereas Sydney's mix is much more diversified between China, USA, and New Zealand. As you can see, only 11% of Sydney's international passengers are from New Zealand. And this comes into play when thinking about the Trans-Tasman bubble. This next slide shows the passenger recovery to date for Auckland Airport. Domestic passengers in the blue line has recovered well and is up to 76% of pre-COVID levels, while international, the dark blue line, is just 16%, only really just starting to lift since the Trans-Tasman bubble has opened. Total passengers is at about 45%, which is in yellow. This chart shows generally the same trend, but for Sydney Airport. Domestic is recovering well, although Sydney is a little bit behind Auckland on the domestic front, given they've seen a few more outbreaks and lockdowns. And recovery in international is also behind Auckland, which makes sense given that passenger dynamic I explained before. And that being Kiwis are a smaller part of Sydney's international passengers than Aussies are to Auckland Airport. But in terms of overall passengers, Sydney is at 41% of pre-COVID levels, which is pretty similar to Auckland's. A really important point that I just want to make here is that while the passenger recoveries are similar, there will be a difference when it comes to revenue recovery. And that's because both airports, for both airports, international passengers generate 3 to 5 times more revenue than domestic passengers. So Auckland, with a stronger international recovery at present, is likely to be slightly ahead when it comes to revenue. I'll probably skip through this slide pretty quickly, but it really just shows the progress of vaccination around the world. This next slide here shows the estimated passenger recovery profile according to the International Air Transport Association, or IATA. So it's estimating that global passengers will recover to pre-COVID levels by 2023. Here at Nikko, we're slightly more cautious on our internal modelling, and I've got Sydney and Auckland reaching pre-COVID levels in 2024. And this is really reflective of a few things: the slower vaccine rollout in New Zealand and Australia, our government's more conservative approach around outbreaks, and finally the time taken to recover from previous air travel shocks. Plus, IATA has actually tended to underestimate the recovery timeframe and has frequently pushed out its forecasts. Just on my final slide here, in terms of sector positioning in the airport sector, we're currently neutral airports as a sector. While we think the recovery is going to take many years, we're also conscious of solid progress being made on the vaccination front globally. There's still a number of unknowns. The timing of passenger recovery is an obvious one, but there are also questions and uncertainties around retail leases within the airports and how they're going to be reset, and also aeronautical pricing agreements between airports and airlines, which have been on hold, but will eventually have to be addressed. So in terms of positioning, we see Auckland Airport as slightly expensive, whereas we see Sydney Airport as showing a little bit of value. So at present, our neutral positioning is made up of an underweight in Auckland Airport, offset by an equal overweight in Sydney Airport. That brings me to the end of my slides, George.
Perfect. Well done, Owen, and congratulations on timing that to perfection. We're bang on 11 o'clock here. So thanks to everyone for joining us for this monthly call. I hope you found it informative and helpful as always. Feedback we appreciate, and we'll see you all again next month. Take care. Thanks. Bye-bye.